Welcome students. I am Dr.P.Vijaya. We are going to see unit number 14, classification of leasing and hire purchase concepts. This is from block 4, fund-based services. Before entering into the topic types of leasing, we will have a general recap. To know about lease. Leasing is nothing but is a process by which a firm can obtain the use of a certain fixed assets for which it must pay a series of contractual, periodic, tax deductible payments. The lessee is the receiver of the service or the assets under the lease contract, and the lessor is the owner of the assets. A lease is a legal agreement that allows someone to pay money so that they can use an asset such as car, building for a particular period of time. Now we will see what are the major types of lease. First, financial lease, next operating lease, third one sale and lease back, fourth one leverage leasing, and fifth direct leasing. First, we will start financial lease. Long-term non-cancelable lease contracts are known as financial leases. It's also called as capital lease. Under this lease, the lessor recovers 90% of the fair value of the asset as lease rentals, and the lease period is 75% of the economic life of the asset. The lease agreement is recoverable. Practically, all the risk incidental to the asset ownership and all the benefits arising therefrom are transferred to the lessee, who bears the cost of maintenance, insurance, and repairs. In India, financial leases are very popular with high cost and high technology equipment. Next, we see operational lease. An operating lease is a contract that permits the use of an asset without transferring the ownership right of said asset. Operating lease is an agreement which gives a right to use assets but does not give the right of ownership of an asset. Leased assets and liabilities related to leased assets are not included in the company's balance sheet. Therefore, the operating lease is considered as off-balance sheet leasing. Examples of this are aircraft, real estate, vehicles, or any heavy machinery. Number 3, sale and lease back. A sale and lease back, or more simply a lease back, is a contract between a seller and a buyer where the former sells an asset to the latter and then enters into a second contract to the lease the asset back from the buyer. Sale and lease back are shortly called lease back. Next, number 4, leverage leasing. A leverage lease is a lease agreement that is financed through the lessor with help from a third party financial institution. The leverage lease is a type of capital asset that involves 3 parties: a lessor, a lessee, and the lender. A leverage lease is a tax advantaged lease arrangement in which a lessor borrows funds to acquire an asset that is then leased to a lessee. In this arrangement, the lessor can recognize depreciation expenses on the asset for tax purposes, while the lessee can deduct its lease payments from taxable income. Apart from this, there are some kinds of leasing. So we will see one by one. Number 1, First Amendment lease. A First Amendment lease is a mix between a capital lease and an operating lease. A First Amendment lease is treated as a capital lease, allowing the lessee to depreciate the equipment on their financial statements. Next, full payout lease. A capital lease is a full payout lease, whereas an operating lease is not. Full payout lease means a lease under which the aggregate rental payments during the original term are at least sufficient to permit the trust to recover the purchase price of the assets leased thereby. Next, guidelines lease. A tax lease written under criteria or guidelines established by the IRS, Internal Revenue Service. The full form of IRS is Internal Revenue Service, to determine the availability of tax benefits to the lessor. Next, we move on to the net lease. In a net lease, the property owner receives the rent that is net after the expenses that are to be passed through to tenants are paid. Next, open-end lease. A conditional sale in which the lessee guarantees that the lessor will realize a minimum value for the sale of the asset at the end of the lease. An open-end lease is a type of a rental agreement that obliges the lessee, that is the person making periodic lease payments, to make a balloon payment at the end of the lease agreement amounting to the difference between the residual and the fair market value of the asset. Open-end leases are also called as financial lease. Next, sales type lease. In sales type lease, the lessor is assumed to actually be selling a product to the lessee, which calls for the recognition of a profit or loss on the sale. Next, synthetic lease. A synthetic lease is an operating lease in which a special purpose entity owned by a parent company purchases an asset and leases it to the operating company. The asset is owned by the lessor for accounting purposes but is owned by the lessee for tax purposes. Next comes the tax lease. A tax lease is any lease in which the lessor, the financier, is considered the owner of the leased equipment for federal income tax purposes. Next, we move on to true lease. A true lease is a type of multi-year lease in which the lessor gives the lessee exclusive rights to use and possess property or equipment for a monthly fee over a specified period. Next, we will see the basic differences between a financial lease and an operational lease. So, some terms we are given for the basis for the comparison. First is meaning. Meaning of financial lease. A commercial contract in which the lessor lets the lessee to use an asset instead of the periodical payments for the usually long period. Whereas an operational lease, a commercial contract where the lessor allows the lessee to use an asset in place of periodical payments for a small period. Next, what is generally it's about? Financial lease is a long-term concept, whereas operating lease is a short-term concept. According to transferability, the ownership is transferred to the lessee in financial lease, and the ownership remains with the lessor in the operational lease. According to the term of lease, it's a contract for the long term, and in operation it is for short term. Nature of contract. The contract is called as a loan agreement, and here in operational lease it is called as a rental agreement. According to maintenance, lessee needs to take care and maintain the asset, whereas in operational lease, lessor take care and maintain the asset. Risk of obsolescence. It lies on the part of the lessee, but in operational lease, it lies on the part of the lessor. Cancellation. It can't be done during primary terms, and in operational lease, it can be done during primary terms. Tax advantage. Financing are allowed for a tax deduction to a lease in financial lease, but whereas in operational lease rent deduction from the tax is allowed. According to the purchase option, the lessee gets an option to purchase the asset. In an operating lease, the lessee is not given so. Next, we move on to the regulatory framework for leasing in India. As there is no separate state for leasing in India, the provisions relating to bailment in the Indian Contract Act govern equipment leasing agreements, as well as Section 148 of the Contract Act defines bailment as the delivery of goods by one person to another for some purpose upon a contract that they shall, when the purpose is accomplished, be written or otherwise disposed of according or the directions of the person delivering them. Since an equipment lease transaction is regarded as a contract of bailment, the obligations of the lessor and the lessee are similar to those of the bailor and the bailee, that is, other than those expressly specified in the lease contract, as defined by the provisions of Section 150 and 168 of the Indian Contract Act. Essentially, these provisions have the following implications for the lessor and the lessee. The lessor has a duty to deliver the asset to the lessee, to legally authorize the lessee to use the asset, and to leave the asset in peaceful possession of the lessee during the currency of the agreement. The lessor has the obligation to pay the lease rentals specified in the lease agreement to protect the lessor's title, to take reasonable care of the asset, and to return the leased asset on the expiry of the lease period. Next, we will see what are the contents to be specified in a lease agreement. So, the lease agreement specifies the legal rights and obligations of the lessor and the lessee. It typically contains terms relating to the following contents. Number 1, description of the lessor and as well as the lessee. Number 2, amount, time and place of lease should be mentioned. Number 3, time and place of equipment delivery should be specified. Lessee's responsibility for taking delivery and possession will be notified. Lessee's responsibility for maintenance, repairs, registration, etc. and the lessor's right in case of default by the lessee will be mentioned. Lessee's right to enjoy the benefits of the warranties provided by the equipment manufacturer or the supplier. Insurance to be taken by the lessee on behalf of the lessor. Variation in lease agreements if there is a change in certain external factors like banking interest rates, depreciation rates and fiscal incentives. Options of lease renewal for the lease. Return of equipment on expiry of the lease period. Arbitration procedure in the event of dispute. Next, we will see what are the problems of leasing in India pertain. Leasing has great potential in India. However, leasing in India faces serious handicaps which may bar its growth in future. The following are some of the problems. Unhealthy competition. There is oversupply of lessor in India. The stiff competition between these lessors are forced them to reduce their profit margin to bare minimum level. Moreover, subsidiaries of banks and financial institutions have competitive edge over private sector lesser due to their cheap source of finance. Next, lack of qualified personnel. Leasing requires qualified and experienced personnel at the helm of its affairs. But in India, leasing is of recent one and hence it is difficult to get a right man to deal with the leasing business. Tax consideration. In reality, the lessee's tax shelter is a lessor's burden. But the lease becomes economically viable if lessor's effective tax rate is low more over taxes like sales tax, wealth tax, additional tax, surcharge, etc. add to the cost of leasing. It makes leasing relatively more expensive. Next, stamp duty. States treats the leasing transaction as a sale for the purpose of making them eligible to sales tax. On the contrary, for stamp duty, the transaction is treated as pure lease transactions. Accordingly, heavy stamp duty imposed on lease document. Next, delayed payment and bad debts. The problem of delayed payment of rents and bad debts add to the cost of the lease. This problem would disturb prospects of leasing business. Next, we will move on to the next new topic, hire purchase, which is somewhat related to the leasing. So, this topic name is hire purchase. So, generally what is hire purchase is? It's a type of installment credit under which the hire purchaser called the hirer agrees to take the goods on hire at a stated rental, which is inclusive of the repayment of principal as well as interest with an option to purchase. Hire purchase is an agreement for buying expensive consumer goods where the buyer makes an initial down payment and pays the balance plus interest in installments. So next we will see what are the legal framework of hire purchase transactions. Under hire purchase agreement, you may purchase goods through installment payments. Possession of goods is delivered by the owner thereof to a person on condition that such person pay the agreed amount in periodical installments. Next, use the goods while paying for them. The property in the goods is to pass to such person on the payment of the last of such installments. Do not own the goods until you have paid the final installment. Such person has a right to terminate the agreement at any time before the property so passes. So every hire purchase agreement must be in writing and signed by all the properties thereto. It is based on the section 3. Next we move on to the rights of the hirer. The hirer usually has the following rights. The duty of the owner in hire purchase agreements gives rise to the corresponding rights to the hirer. The following are the rights of an hire. Right to sue in damages for breach of hire purchase agreement. Next, right to be notified the cash price of the goods. Next, right to copy of the hire purchase agreement within 21 days of conclusion of the purchase agreement. Next, right of quiet possession of the goods let under the hire purchase agreement. Right of indemnity for any loss or liability caused by reason of any defects in the goods or of the title. Right to terminate the agreement. Right to complete the hire purchase agreement. Next, we will see the obligations of the hirer. The hirer usually has the following obligations: to pay hire installment, that is the duty of the hirer, to pay hire installments, to take reasonable care of the goods, to inform the owner where the goods will be kept. Next, we will see the owner's right: to forfeit the deposit. Next, to retain the installments already paid and recover the balance due. To repossess the goods, that is, which may have to be by application to a court depending on the nature of the goods and the percentage of the total price paid. And last one is to claim damages for any loss suffered. Next, we will see what are the general features of hire purchase. First one is immediate possession. Under hire purchase, the buyer takes immediate possession of goods by saying only a portion of its price. Next, hire charges. Under hire purchaser, each installment is treated as hire charges. Next, property in goods. Ownership is passed to the hirer only after paying last or specified number of installments. Next, down payment. Hirer has to pay 20 to 25% of the asset price to the vendor as down payment. Repossession. Hire vendor, if default in payment of installment made by hirer, can repossess the goods and he can sell the goods. Return of goods. Hirer is free to return the goods without being required to pay further installment falling due after the return. Depreciation. Depreciation and investment allowances can be claimed by the hirer even though he is not an exact owner. These are the basic or the general differences between the lease and the hire purchase. First is ownership. In lease, ownership rests with the lessor throughout the entire life of the asset. And in hire purchase, the hirer become the owner till the payment of the specified installments. Method of financing. Leasing is a method of financing business assets, whereas hire purchase is financing both business and non-business assets. Depreciation. In leasing, depreciation and investment allowances cannot be claimed by the lessee, whereas in hire purchase, depreciation can be claimed by the hirer. Next, tax benefits. The entire lease rental is tax deductible expenses. Only the interest component of the hire purchase installment is tax deductible. Next, salvage value. The lessee, not being the owner of the asset, does not enjoy the salvage value of the asset. The hirer in hire purchase, being the owner of the asset, enjoys salvage value of the asset. Deposit. Lessee is not required to make any deposit, but whereas in hire purchase, 20% of the deposit required in hire purchase. Nature of deal. With the lease, we rent, and hire purchase, we buy the goods. Nature of deal. Extent of finance. In lease financing is 100% financing since it is required down payment, whereas hire purchase requires 20 to 25% of the down payment. Maintenance. Cost of maintenance hired assets is borne by the hirer, and the leased assets other than financial lease is borne by the lessor. Reporting. Hire purchase assets is a balance sheet item in the books of hirer, whereas the leased assets are shown as off balance sheet item. And this is the general basic RBI guidelines for hire purchase business. Under section 610 of Banking Regulation Act 1949, the Government of India has permitted banks to engage in HP business. Following are some of the important guidelines of RBI for hire purchase business of banks. Banks shall not themselves undertake directly or departmentally the business of hire purchases. Banks desirous of undertaking hire purchase business through an existing companies or new subsidiaries will require prior approval of RBI. Banks' investments in the shares of subsidiaries engaging in leasing and hire purchase business shall not exceed 10% of the paid up share capital and reserves of the banks. Without prior approval of RBI, banks shall not act as promoters of other hire purchase companies. Next point, prior clearance of RBI is required for the purpose of any application to the controller of capital issue in the case of IPO of new subsidiary and FPO of existing subsidiaries of banks. Bank shall furnish necessary information regarding its hire purchase or equipment leasing subsidiaries as when RBI demands. Next, we will see advantages of hire purchase. Spread the cost of finance. While choosing to pay cash is preferable, a hire purchase agreement allows a customer to make monthly repayments over a pre-specified period of time. Interest-free credit. Some merchants offer customers the opportunity to pay for goods and services on interest-free credit. Higher acceptance rates. The rate of acceptance of hire purchase agreements is higher than other forms of unsecured borrowing because the lenders have collateral. Sales. Hire purchase agreement allows a consumer to purchase sale items when they are not in a position to pay in cash. Debt solutions. Consumers then buy on credit can pursue a debit solution such as debit engagement plan should they experience money problems further down the line. These are the general problems of hire purchase business faced in India. Personal debt. A hire purchase agreement is yet another form of personal debt. It is monthly repayment commitment that needs to be paid each month. Next, final payment. A consumer does not have legitimate title to the goods until the final monthly repayment has been made. Bad credit. All hire purchase agreements will involve a credit check. Consumers that have a bad credit rating will either be written down or will be asked to pay a high interest rate. Creditor harassment. Opting to buy on credit can create money problems should a family experience a change of personal circumstances. Repossession rights. Seller is entitled to snatch back any goods when less than a third of the amount has been paid back. Tax, wealth tax, additional tax, surcharge, etc. add to the cost of leasing. It makes leasing relatively more expensive. Stamp duty. States treats the leasing transaction as a sale for the purpose of making them eligible on sales tax. On the contrary, for stamp duty, the transaction is treated as pure lease transactions. Accordingly, heavy stamp duty imposed on lease document. Delayed payment and bad debts. The problem of delayed payment of rents and bad debts add to the cost of lease. This problem would disturb prospects of leasing business. Thank you.